Hey everyone, happy Friday today. It's Cameron Wilson from Dominion Lending Center's Canuck Mortgage Group. Today is Knowledge Drop Friday, and right now we're in an era of higher interest rates, and gaining the edge on affordability is critical if we're going to be able to meet our goals in the real estate market. So today we're going to learn about the power of offset ratios. And these come into play if a client is buying or already owns rental properties. Mainstream lenders like big banks, credit unions, and mortgage finance companies use a particular calculation for their usage of rental income versus alternative lenders and some smaller banks. This is a case study of a client that recently closed their mortgage with me. The client wished to purchase a new primary residence and leave their existing home as a rental property. This new purchase closed with a purchase price of $497,500. The client put a 5% down payment down, and the annual property taxes on this property were $3,189 per year. A little bit about the client. The gross family income for the clients were $103,126 per year in employment income. Credit scores were 700 plus. Unsecured monthly debts going into the purchase were $235. The down payment at 5%, $24,875 in this case. They already had an existing primary residence. The mortgage on that property, $1,190 per month, and annual property taxes at $2,212 per year. This property will be left as a rental property, generating $2,200 per month in rental income. The tenant's responsible for utilities and telecoms. Now, using the mainstream rental calculation that big banks, credit unions, and mortgage finance companies use, 50% rental income add-back calculation. And that's being used on the property they're leaving as a rental property for $2,200 a month. The maximum purchase price they would have been eligible for using this style of rental calculation, including their $24,875 down payment, would be only $375,000 purchase price, far less than the required $497,500. Now, because of my knowledge in the market, I was able to select the appropriate lender. We were able to use a specialized lender, a smaller bank in this case, who allows us to use an 80% rental income offset calculation for the non-subject rental of $2,200 per month. The maximum purchase price, again, same down payment, $24,875. In this case, the maximum they could have went was $506,000 compared to only $375,000. That's a difference of $131,000 in added affordability from simply a nuance in policy. In this case study, we did use an A lender, and the client received a market competitive interest rate with no lender or broker fees. It was a slam dunk for my client. We achieved their objectives and goals. Now they are happily enjoying their new home while broadening their asset base. I hope this was helpful, and there will be more to come. Again, this is Knowledge Drop Friday. Thanks for tuning in, and I hope this was helpful to you. Thank you. Take care, guys.